Peloton just released their last quarter earnings, rounding out the financial year 21, and they were bad. Well, they weren't really bad, but they were worse than what analysts were expecting. So we'll break them down in this video and explain why they weren't actually as bad as you might think. Following their announcement of a $313 million loss, the stock price fell 6%, and after hours it was fluctuating around 13% at one point. So you might think Peloton is a no-go stock, it's just crashed, don't touch it. But let's take a step back for a second. They were never meant to be profitable just yet. In fact, their first ever profitable quarter came after the biggest boom in the at-home fitness industry or market that we'll likely ever see. So it's reasonable to expect a bit of a pullback in their earnings. They still did double their year-on-year revenue, and they've managed to keep up reasonably well, and I say that very loosely, reasonably well with demand, all the while having a huge supply crisis on their hands. Analysts would be remiss to expect Peloton to continue to increase their revenue after an absolutely booming 2020. So let's look at some actual numbers. They've basically been doubling their revenue year on year since 2017, and that includes the year just gone, but the key part being they didn't forecast to double their revenue in financial year 21, and they certainly didn't forecast to be profitable, so we should never have expected them to continue being profitable. Going forward, profitability is going to be hugely reliant on their subscriber base, their paying subscribers. I think it's about $30 or $40 a month at the moment, and this is where the bulk of their profits come from. There's not a whole lot of cost associated with delivering this, but there is a whole lot of upside potential to it. And they've been continually growing their paying subscribers quarter after quarter, as you can see here. Now, I've given the bull case, and that is that this past year has been completely unexpected, and we shouldn't really be judging them based on what's happened in this past year and expecting them to continue profitability, and I think that's fair, but then we can't also just ignore it completely. So we'll look at some financial statements, and when we are looking at these, it's important to note that they are in financial years, not calendar years. So 2020 doesn't really include much of the pandemic. 2021 captures most of it. This is the quarter just gone, and this is the comparable quarter from 1 year ago. Now, revenue is tracking along quite nicely. Their product sales grew quite considerably, and their subscriptions revenue more than doubled, which is really promising because that revenue, as we talked about before, has really high margins. That brings the total revenue for the quarter to $936 million. Moving down one line, this is where it gets slightly more concerning. It's their cost of revenue. This is the amount it costs them to bring in that $936 million in revenue. We can see the total cost of selling their products has doubled, while the revenue received has only increased by 50%. Now, gross profit is just the total revenue minus the total cost of revenue, and generally you would expect it to increase as total revenue increased, but we can see here that the total revenue has increased by more than 50%, gross profit has actually decreased. Not a good sign. That, along with a huge increase in operating expenses, has meant they posted a significant $300 million quarter four loss. Now we're starting to get a better picture of why the share price fell back a little bit last week. It's also important to note that the big run-up we saw last year was not just the result of beating targets, it was actually the result of smashing them. So this quarter four, they didn't achieve their targets. Of course, it's going to pull back quite a bit. When they IPO'd in late 2019, no one was expecting them to be profitable so quickly, so naturally the stock price rewarded them, but they can't keep up that forever. Looking forward now, their outlook is definitely positive. They're expecting to continue to increase their subscriber base to the point where it makes up 60% of their revenue by the end of this financial year. They're expecting growth to slow substantially despite the release of a new treadmill product and the lowering of price of their entry-level exercise bike, but we could see sustainable profitability in financial year 23 if their modeling is anything to go by. It's a hot stock, let's not deny that. Its price has more than quadrupled in the 2 years that it's been public, but not without good reason. Their revenue has also quadrupled in that same time. Peloton has proven that they can be profitable, albeit not sustainably, but this is a good buy stock, despite the fact that they're going to face stiff competition in the coming years. You're buying the stock at a heavy discount, especially when compared to the start of 2021. The Wall Street consensus, if you care about that, is to overweight this stock, with the vast majority of analysts saying to buy. So there you go. Peloton, it's a good stock. Get amongst it.